Good morning, gang. And guess what? It's Tuesday. Now, Tuesday is always our special day because we get experts along, and none other than Jackson Milan. He's a wealth coach. As many of you know, he's part of the SAC and also his team. And I must say, the way he talks about money makes it easy to understand. Now, when it comes to money, we keep saying this, but if you work your money as well as you do your football team and you work the things that you love, well, guess what? It'll actually be your best friend. And what we're going to be doing over this period of time with Jackson, he's going to be sharing some of his golden nuggets on what to do, what not to do, and how to take advantage of the opportunities that are presenting themselves right now. So Jackson, welcome, mate. Thanks for coming.
Thanks for having me again. I didn't scare you off last time.
Mate, the feedback was terrific, and people just say, oh my goodness, I'm in. And I must say, your innovation in wealth creation with all the things that you do with your academy and with your, your beginners and also the people in business, I've not seen anybody do anything like it. So you're really ahead of the game, mate. And I must say, you make this hard stuff sound easy, and it's always sound easy when it comes from an expert. And I love the way you and your team actually walk people through. So that's one of the reasons I've got my question. My big question for you today. My question is, what happens when you don't have expert wealth advice? And the big rock here is what you need to know to get started. And we'll start with that. So the thing I'm really like to know, and I think a lot of people know, what's the difference between a financial advisor and a wealth coach?
Yeah, great question. Here's the thing. I've got a lot of clients that are financial advisors. And I think it's quite funny. We've kind of turned it into the financial advisor inception, that we're teaching financial advisors how to create the financial advice industry of the future. And I think one of the reasons why we binned the term financial advisor and we donned the term wealth coach is based on my experience in the industry and many people's experience with our industry. And unfortunately, there have been a lot of cowboys and I'm sure cowgirls in the financial advice space, not just in Australia, but globally. Now, my first advice role was in a place called the Financial Advice Centre. I was 19 years old and I got into the advice industry, as I mentioned before, because my parents didn't have a great relationship with money. They tried their hand at business, they tried their hand at pretty much everything and could never crack the code. And I think it came down to their relationship with money at the end of the day. And for that reason, no matter how hard they tried, how hard they tried to commit themselves, everything that they stood for to success, they never seemed to be successful. And I wanted to break the cycle. The moment that I can still remember as if it was yesterday is that I was probably about 10 years old. I'd come home from school and then on the kitchen table, there was a pile of unopened bills. And I knew at the time I couldn't really contextualize exactly what it meant, but I knew it was wrong. I knew that if you got a bill, you should open it. So I asked my mum and I said, Mum, why haven't you opened all of those bills? And she goes, well, I know what's inside. So she just buried her head in the sand. If the bill wasn't open, it didn't exist. And I realized that I needed to create a catalyst for change. So I decided from a very young age, I actually wanted to be a vet. My first word was vet. Anytime anybody asked me what I wanted to do, it was become a vet. I wasn't very much of a dedicated student. Wasn't on the right study path. And then I was probably in year 11 and I was told, oh, Jackson, you realize you're never going to make it into veterinary science. And I go, oh, shit. Oh, it would have been good to know that a long time ago. What am I going to do with my life? So I asked my dad, I said, Dad, I can't get into veterinary science. It's what I wanted to do my entire life. What should I do? He said, Jackson, if you want to make money, you need to be around money. I took that very literally. So I found myself...
I'm just going to interrupt you there. I think I want to get people to write stuff down. I think something just comes out of your mouth, which is second nature. But I think it's a big rock you just said. If you want to make money, you've got to be around money or people that can make money or that where the wealth is. I think that's a big deal. Good.
And I took that very literally, Steve. I went on to Seek and I found, just out of chance, an internship at a place called the Financial Advice Centre. So at the ripe old age of 19, without the beard, I looked about 12. I turned up for my first day and I was in shock. I walked into this bullpen of about 500 people, which was just one floor of this office building in the city of Sydney. That was absolute chaos. It was like when I saw the Wolf of Wall Street, I go, wow, that's the Financial Advice Centre. It was everything that you see in the Wolf of Wall Street, except the midget throwing. There were people carrying on, ringing bells when they made sales, clapping and carrying on, essentially celebrating what I then came to understand was them taking advantage of uneducated individuals for their own personal gain. And the defining moment for me was the moment that I realized that the advice that they were giving their clients was the exact opposite to what they were doing themselves. And they were the ones driving the nice cars and living in the nice penthouse apartments and wearing the $5,000 suits. And it was their clients that were eating shit. And I knew something was wrong. So I decided that I was going to do things differently. And I started to develop a model from the ground up that then became our values-based advice approach, which has helped us educate over 1,000 clients to build 1.2 billion in combined wealth.
Wow.
So what is the difference between an advisor and a coach? An advisor can tell you what to do, and they can create the right plan, and they can even take all of the heavy lifting off you and put it all into place on your behalf, which to many people go, wow, that sounds amazing, which for many it can be. They do all the heavy lifting. You outsource the implementation of your finances to an independent third party. However, in my experience, that has a number of fundamental flaws. One, a plan is only as good as your ability to follow it. You can have the best plan that captures every single strategy that is perfect in theory, but absolutely fails in execution. And it's because you've overlooked the number one limiting factor in your life, which is you. And the second thing is that they've given you fish and you're maybe going to eat for a day, but they haven't taught you how to fish. So how are you going to eat for the rest of your life? And that is what we do differently.
Isn't it interesting you should say that, because we have the best of intention. We'll do training and so forth. And, you know, that's with us with the SAC and also with impact training. One of the things I didn't want to do was just to do rah-rah sessions and just say, hey, you got the tools, go and do it, because we can't do it alone, can we, mate?
Not
I mean,
at all.
at the end of when we will learn something, we're always going to drop the ball because we don't live in that world. And that's why we need expertise and a coach or someone or a mentor to help you along the way. I know you have people in your life to do that. Yeah. I do. We all need that. And it's interesting that everyone says, oh, they want to make money, but they just play money. They don't actually get coaching. So that's a big difference, isn't it? Here, we'll do this for you. We'll work it in this, we'll whack it in that. We'll see how we go, but they don't let you, they don't teach you what needs to be done. So you can be part of the equation. And if we leave it to people, I find that they let themselves down more often than anyone else on the planet.
Correct. And I think this is the thing. Most people are chasing the what. They deal in the tactics when it comes to their finances. Oh, so-and-so's just bought some Tesla shares. I want some Tesla shares. Oh, so-and-so's gone and invested in this managed fund. I'm going to go and get in that managed fund. Oh, the barefoot investor told me to put my super in Host Plus, so I'm going to go do that too. But because you don't understand the how, and more importantly, the why, that you are just rolling the dice.
Well, that's what people do. You're right, Jackson. Just yesterday, someone said, oh, I did this and I created that. It was great because the stock market dropped and it went up. And I went, oh, should I do that too? So that's exactly what happens. And I'm sure the listeners are thinking, wow, gee whiz, that's what a lot of what I've done or what I've been thinking of doing.
Yeah.
So how do we actually analyze that then? Because there's lots of things that people can do for their wealth. For instance, I mean, you told me this. It's like, well, firstly, we can do a debt reduction plan, or we can have an estate planning plan, or we have, let's say, insurances. We could have different super that will lower costs, higher yield. And of course, there's stock and also property and so forth. So what types of plans should someone be thinking about when they come to a coach, not an advisor by the sound of things, to be able to be shown what to do it with them, I'm suggesting, and then start from, let's say, 101.
Yeah, so here's the thing. All of those things are vehicles. They're tools. They're hammers and screwdrivers. We've firstly got to realize, where are we trying to get to? What's the destination, or what are we trying to build? What is the structure? And when we're looking at any structure, we're looking to build anything, we need to firstly create the right foundation. Now, if you intend to build a house and you build the foundations that's there to support a 2-story house, and then midway through you decide that you want to build a skyscraper, it's not going to work, right? Because you're going to have inferior and insufficient foundations to support you to build what you want. So you firstly need a plan, you need a blueprint, you need to engage an architect. And the architect is going to ask you, okay, Steve, what are you trying to build? How big is the plot of land? What's the aspect? What's the end goal? Okay, now we've got a big picture, then let's reverse engineer it. How many floors do you want? How many bathrooms? What are the amenities? What do you want it to look like? What's the profit that you're trying to make at the end? It's understanding the motivators. And that allows us to reverse engineer that into an action plan, and then deploy the appropriate tools and the appropriate tradespeople to execute on that strategy.
So it sounds to me that what my friends and that I know out there, and a lot of our clients, they say we want this, we want that, we want the tools and so forth, but we haven't said, well, let's leave it aside and let's create a plan first, and let's forget about the noise. Let's have the plan, and then we can see if the foundation will support what you want. And sometimes what they want it changes.
100%, and it always changes. So we take our clients through an exercise whereby we complete what we refer to as an annual roadmap. And we do this at least once a year, and we map out all of their goals, both lifestyle and financial, over the course of 20 years. Now, anybody's listening to this, like, 20 years, wow, that's a long time. I don't know what I want tomorrow, let alone in 20 years' time. But it's this process of going through this framework and thinking longer term into the future that allows us to then condition ourselves to presuppose that the short-term milestones are going to be met.
Look, I think everyone should listen to what Jackson just said and take note. In goal setting and so forth, we say we want this over the next years and so forth. We progressively get to an older age. What works more effectively, and all of the programmers and all of the very clever psychologists say, go to when you're 80 years, 100 years of age, and work backwards to reverse engineer it, so to speak, and say, what are you doing? What do you need to be doing? And who do you know to get you back to today? It comes backwards, because all of a sudden, if you're 2 weeks away from where you want to get to when you're 80, 90, 100 years of age, you're nowhere near where you need to be. So hear what Jackson's saying. This is really important as far as setting the foundation. So it's a good paradigm, mate.
It's huge. And here's the thing. We've got to realize that, firstly, one of the things that most people overlook is that they don't have an operating system for their money, right? And we've developed a framework that we call the wealth pyramid. And there's basically 5 stages of financial success that everyone is going to be at some point of their life. The biggest problem that most people have is they don't identify where they are out of these 5 stages now. They don't identify where they want to be, which means it's impossible for them to bridge the gap. They're just guessing. So I'll run you through the 5 stages. Stage 1 at the bottom of the pyramid is what we call financial battle. So this means that in business, your business is running at a loss. You're burning through cash at a rate of knots. You can't sustain your lifestyle, and you're typically burning through cash, or you're racking up debts to bridge the gap. You're drowning financially. Stage 2 is financial comfort. If you're in business, business is taking care of itself. It's break even. You can live a comfortable lifestyle. You don't go without anything, but you don't have anything left over. You're treading water. Stage 3, financial growth. It means the business is profitable, and personally, you've got surplus. After you live your lifestyle, there is money left over, and you're making that money work. You're saving, you're paying down debts, you're building wealth, potentially all 3 of those things. Now, stage 4 is financial freedom. Now, I'm sure all of you have heard that term thrown around many times before. It's very subjective. What financial freedom means to you, Steve, is different to the next person. But I simplify it to 2 things. You own your home in full, and you've got it completely paid off. And that you have enough passive income that you've got the freedom to choose what you want to do with your time. And then stage 5.
Say that again, my friend, because that's a really lovely paradigm of freedom. So guys, I hope you got this pen. Write this stuff down.
Yeah. So you own your home and it's paid off in full, and you have enough passive income that you've got the freedom to choose what you want to do with your time.
Lovely.
And then stage 5 is financial abundance. Not everyone wants it, but it's the blue sky strategy. It's where you have more than what you need to achieve financial freedom and you can now give back to family, friends, charity, things that you believe in. So, to you guys that are listening, what stage are you at out of those 5 stages right now? Battle, comfort, growth, freedom, or abundance?
Okay, so the first one's battle.
Yep.
It's when you're really struggling, you haven't got 2 bob to bless yourself with, and you're really sort of eating chips.
Drowning.
We've all been there, haven't we? What's the next one?
We've got comfort, where you break even, treading water.
We're treading water, breaking even. So that's
growth, where we've got surplus.
Growth is when you've got a little bit extra.
And you're making it work.
And then surplus is?
And the surplus is what we've got left over. So we've got profit or we've got excess cash flow that we can save, pay down debts, build wealth.
Right.
We've then got freedom. Own your home, paid off in full, and enough passive income where you can do what you want with your time.
Nice.
And then abundance. You've got more than what you need and you can give back.
All right. See, guys, see what Jackson's doing? He's putting you in a place at this point of time. You say, well, hang on a tick. Let's have a reality check-in. And sometimes it's good to talk to someone about it. Sitting at home doing it by yourself is not a good idea. Been there, done that. Makes you really unhappy. Then you say, what do I do? That's why we're talking about why it's important to find a wealth coach or advice from a wealth coach. So if you're sitting here right now and you've written down, I'm at number 1, number 2, number 3, the question I'm going to throw out to you guys listening is, where do you want to be and what are you going to do about it?
Yeah.
So, given that we've given them a little something to think about, and hopefully they've written some stuff down, what are the 3 big mistakes, mate, that people make when they go, yep, I'm in number 2. What do they do wrong and come a cropper?
Yeah. So what we need to realize is we need to define where do we want to go ultimately, and then by when. Because the when is really important because that gives us a timeline. And then that allows us to work out, is it realistic and what do we need to do to get there? The biggest things that people do wrong is that they take too much risk and they're trying to jump stages. So let's say they're at stage 1 or stage 2 and they want to get to stage 5. And I've never seen it happen. I've worked with clients that have $100 million businesses and have huge amounts of net worth. And if they're at a certain level and they're trying to jump ahead, even then it doesn't work. And you end up taking too much risk. The other thing is that they take risk or they try and pursue a particular outcome or a return without considering the risk associated with that. Everything in life is risk versus return. You need to take a relative amount of risk to the reward you expect to achieve. And the more reward you want, the more risk that's going to be involved. And the third thing is that they're inconsistent. They think that one decision is going to make up for 10 years of indecision. It doesn't work. You need to take consistent action.
Okay. Let's go back to number 1. Given that that's a mistake, and it sounds to me that it's a regular mistake. I think all of those mistakes are quite rife. I'm sure all of our listeners are saying, yep, that's me, or was me, or that's my daughter, or that's my son. Now, number 1, with that mistake, what must a person do to avoid it or to stop making that mistake?
You need to understand the levers. So there are 3 levers in wealth creation. There are no more. The first lever is how much can you contribute towards the goal, the contribution lever. The second lever is how much risk are you prepared to take, second lever. And the third lever is how much time can you afford to wait.
Ooh, yes. I'll do it next month. I'll do it next year. I'll get my finances sorted after Christmas.
And that's a thing. Tomorrow never comes, right?
That's all right. All right. Okay. Number 1. So we're going to fix that mistake with those 3 actions. Just repeat those actions again, mate.
So we need to understand the contribution lever. How much can we afford to contribute? 2, how much risk are we prepared to take?
Yep.
And 3, how long are we prepared to wait?
All right. Have you wrote that down? Okay. Number 2 mistake. How do we fix that one?
So we need to have an education. The problem is that most people are taking risks from an uneducated perspective. And this is the difference between investing and gambling.
Yes, big difference, guys. Listen to that. People go and say, oh, I'll do an investment, but it's a gamble. It's like, oh, I've got this thing. I'll make $1 million because it'll go through the roof. That's called gambling.
And I made a post about this the other day. So I was working for a big bank as a financial advisor, and I had a client that called in, a new client. And when I answered the phone, there was a person on the other end of the phone that was inconsolably crying, just sobbing, an absolute mess. And for a little while, I thought it was a prank call. But I waited. I just let him cry and was like, are you all right? Just let him get it out. And then he said, I've fucked up big time. So he composed himself and I said, talk to me. What happened? So he thought that he would start getting involved in trading. And he'd started with shares, progressed his way to options, and then found himself investing using a derivative that's called a CFD, or a contract for difference. Now, a CFD, without getting too technical, is essentially a bet against a trading house of the direction of an underlying investment asset. So it could be a stock, it could be a currency. And what you're basically saying is, let's say we had this bet, Steve. I say, Steve, I bet that the Australian dollar against the US dollar is going to go up. And you're like, Jackson, I've got your bet. I reckon it's going to fall. How much do you want to wager? Oh, well, I wager this much. Okay, great. Well, if I win, I make this much. And if you win this much. The problem is there is infinite amount of loss. There is infinite potential. And this guy had got lucky. He started small, $1,000. He said, Jackson, I thought I'd worked out the market. I thought I'd found a loophole. So I remortgaged my house. I borrowed money from my best friend. And the worst thing possible could have happened. The market fell, lost my house, lost my wife, lost my best friend. Because he didn't understand the risks. There's even a recent example of this that many of you might have seen in the media, that there was a young kid in the US who was trading CFDs on a platform called Robinhood. And he woke up one morning to his account being $750,000 in the red. And he took his own life. Now, these are the repercussions of not being educated. I don't say this to scare you, because the most common question I get from many of my clients as they're going through the process and getting educated is, well, Jackson, is there a possibility for me to lose money? And the things that we advise our clients on, no. The market, when you're investing in good quality blue chip companies and in the style of investing that we use with all of our clients that's called index investing, the market has never taken a dollar from anyone. What's taken dollars from them is their behavior.
Right. So that's that risk factor you were talking about with number 2. Wow.
Think about it this way, right? Well, many people have the misconception that lots of people lost immense amount of money in the global financial crisis. Like, I'm sure you've heard horror stories of retirees saying, I lost 40% of my retirement savings. And the reality is, for most of those people, it's not true. What they did is that the market fell, they sold down their portfolios and moved it to cash, which meant they crystallized the losses.
Yes.
Now, let me put this into perspective for most people to understand. Let's say that we own a property, a beautiful property, one that you live in that's worth $1 million. And then you go home tonight and somebody comes and knocks on the door with a briefcase and they say, hey, if you move out tonight, I'm going to give you this briefcase and it's got $600,000 in it. Would you take it?
No.
Why?
My place is worth more than 600,000.
Exactly. So they can make the offer. You might slam the door in their face. You might respectfully decline and send them marching. But the only time you lose money is when you take the briefcase and you move out.
Yes, you're right. Because then they say, well, that's money in the hand. I'll take it now. But then that's crystallized. It's actually
Correct.
What they call it, realizing.
You've realized your loss.
Yes.
So when the share market falls, it's somebody knocking on the door with a briefcase. Now imagine that you've got a briefcase that's got 600 grand in it. And your next door neighbor whose house is exactly the same as yours, that's worth $1 million, and you've heard whispers in the halls that they're happy to take 600 grand for it. And you've got the money ready to go. What would you do?
Oh, go and offer it to him.
And why would you do that?
Because I'd like to see if he'd like to take the cash and run, and then I would sit on the property until it started to increase in value.
Exactly. And this is a strategy called dollar cost averaging, which we get the opportunity to do in the share market every single day. So what I condition my clients to do, which overcomes that issue of the risk versus return, is when the market falls, they get excited. And it takes us a while, but with the right education, with the right strategy, with the right tools, we can change the behavior.
If you've got someone that knows what they're talking about there, you're confidant, you can say, hey, Jackson, hey, Stan, hey, you're an expert, help me. And then you've got a way of doing things which minimizes risk, but also maximizes opportunity. Yeah,
Correct.
That's great, because that gets rid of that second mistake.
Correct. And this is what one of Warren Buffett's mantras is: be fearful when others are greedy and be greedy when others are fearful.
Right.
And it's been proven that the typical herd mentality of uneducated investors, they buy high and they sell low. And it's because they feel like they're missing. They feel like they're missing out, that the market's going up, and they're like, oh no, I'm going to miss the boat. I better get in. And they get in, and the market starts to fall. Oh shit, it's going to fall more. I better get out now. And then when the market picks up again, I'm going to get in. And we've proven that if you miss even one out of the top 4 days in the market over any particular year over the course of now and retirement, you can have an impact on your retirement savings of between 15 and 30%.
Wow. Say that again, mate, please.
So if you miss one of the best days out of the top 4 days in the market in any one year, that can have an impact in your retirement savings between 15 and 30%.
Jeez.
One day.
Wow.
So
that's why you've got to make sure you have expert advice, but not just financial planning. You've got to have someone that's watching your back, teaching you, and also working together. Otherwise, how would you ever know when out of 365 days of the year, what days we've got to watch? What indicators?
And we've proven that once your money's out of the market, from a human behavioral perspective, as a human being, we feel more pain on when we're losing money than the gratification we get when we're making money.
Wow.
So for that reason, when our money's out of the market and we're being tactical, trying to get in and get out and get in and get out, and once that money's out, we now have comfort. And the potential uncertainty of getting money back in the market, the threshold is much higher than getting out. So for this reason, most people just sit on their hands. And we've seen many people over the course of the last bull market who haven't followed our advice. It has cost them hundreds of thousands of dollars, if not millions of dollars in opportunity cost over the course of their lifetime, because they sat and did nothing.
Okay, so sedentary lifestyle and money management also is detrimental to your financial health.
Correct.
Right. All right, well, that's gold. Before I get the guys to ask a few questions, the third mistake, how do we fix that?
So the third mistake is creating an investment operating system. You got to realize, guys, that you're all busy. Everyone's busy. And if you are relying on yourself and your own behavior and your own habits to keep your finances moving forwards, it is a losing battle, trust me. Because for most of us, myself included, I don't want to spend my waking hours thinking about my own personal finances. I've got better things to do with my time. So it's about creating an investment operating system where you can set it on autopilot.
So it's an operating system that creates wealth and you continually nurture it with an expert.
Correct. And here's the thing. Once we set up the strategy, the investment strategy is in place. You don't need to worry about speculating and trading in the markets or having to sit in front of spreadsheets all day, every day. We only have one factor that we need to control: how much we contribute. Because we've already dialed in the timeline. We know the plan. We know what building we're trying to build. We've selected the tools and we've implemented them. We know the risk tolerance that we're prepared to take in order to achieve that goal. So that only leaves that one lever, and the most important lever is the contribution.
And guess what? One of your clients told me just the other day, he'd been going through some bits of changes and so forth, and he went and looked at the structure to put in, and he's seen the return, and he said, gee whiz, I'm looking forward to putting a bit more in. Exactly. To make sure we get more of a return. He was so excited because it was passively generated, but it was within his operating system. Correct. And this is I can speak to everyone here because I'm seeing it, I'm feeling it, I'm watching it happen in front of my eyes, and also one of my really good mates and also clients. So it's working with the operating system and then saying, well, what's the contribution to all of the different let's say opportunities that are opened up, but opened up by an expert, but not just say, just do a speculation.
Exactly. And then all we need to do is every quarter we increase how much we can contribute, because the aim is that all of you are smashing your targets with your sales. So you're earning more money. So you've got more surplus, which means we can put more money in, which means that we get the snowball rolling bigger and bigger and bigger.
Terrific. Now, I'm sure that Dee and Darren will have a question or two. So why don't we just open up to them, because
Fire away.
Dee or Darren, do you have a question?
Yeah, sure. Jackson, you were talking about the relationship and helping your clients understand the relationship with money. And you know, we see it in sales as well, where sometimes people say, oh yeah, I always do that subconsciously, which is an interesting comment, because if it's subconscious, you don't know you do it. So how do you help your clients understand what is their relationship with money if it's subconscious actions that are causing, you know, their frequent activity?
Yeah, great question. So we bring this back to a framework that's called Tiny Habits. And there's a book called Tiny Habits. It's written by a guy by the name of BJ Fogg. Great book. And what we've got to realize is that we need to realize that a particular outcome is as a result of a trigger that has led us to doing the actions to result in the outcome. And if you say, oh, I never have money left over, I can't stick to my budget, that is a lag indicator as a result of other things that are not happening in your workflow of money. So you don't change the budget. You need to change the triggers that result in you either sticking or maintaining the budget. So that's the first thing that we need to realize, because it's like in a business. If you're focusing on dollars in the bank account or the revenue that you make in a month, once you've got the money in the bank for the month, that's a lag indicator. You can't change it. Like, unless you're going to get into your DeLorean and hit 88 miles an hour and go back in time, you can't change it. What you do change is the lead indicators leading up to that. And you can influence those things and create the right structures. The other thing that's really important is money is not the objective. And too many people are blindly chasing money. Money doesn't matter. You know, I guess it's a little bit ironic when we're talking about this segment being money matters. But money is just the vehicle. And at the end of the day, it's an inanimate object where it only has value because we've placed value on it. It's the currency in which we deal in to be able to achieve the things that we want. So money is not important. It is what you want that is important. And the thing that is most often overlooked is, what do you want? Like, ask yourself the question, what do you want? And if what you want is important enough to you, and then we can reverse engineer it into the how, then we can work out the what needs to happen to allow you to achieve those outcomes. And so far, we've never lost yet. For every client that we've worked with, that we help them create that shift, and we reprogram the pattern, we get them clarity around what they want, and more importantly, why they want it, which we spoke about in last episode. Then they go, wow, I get it now. And everything changes.
Terrific. Thanks, Darren. Dee, have you got a question there? Are you going to be able to, I'll unmute you. If you'd like to ask a question, you can ask Jackson.
I don't actually have a question, because I've just started working with Jackson and Sal myself. Okay. So a lot of the stuff that he's covering, I'm actually learning about off Sal.
Terrific.
Beautiful. Love that, Dee. I know there's going to be big shifts that we're going to make, so I'm looking forward to it.
Yeah, no, so am I.
Dee's our doer, I can assure you. All right, let's continue on our merry way, my friend.
Please do.
Now we know what these mistakes are, and I must say the analogies and the way you put how to maneuver that accordingly to eliminate those mistakes, I think you've made it, I bet you pounds to peanuts, people are going, my goodness, you're talking about me. Now, I always like to talk about red flags, you know that. If we're sitting in a place on the boiling frog syndrome where we're just sitting in the pot or whatever the case may be, and we're not taking action, what are some of the red flags that need to come up that we should say, oh, I need to start getting advice? What are some of the indicators, not the mistakes, because that's when people have taken action and done it wrong. What are some of the red flags? Now, I think you said one of them, I just, to make sure that what you want to do, you will do whatever it takes to make your sales, to increase your activity, and all that sort of stuff, and just go the extra mile to be able to do that. But what's a red flag that's going to come up in people's lives or situations that they're going to say, hang on a tick, I've got to get some advice, but I need some coaching?
Here's the biggest red flag, Stephen. I think that it's one that goes under the surface. And because most people perceive it to be so difficult to work out what they actually need to achieve financial freedom or to have that freedom and flexibility in their life, that they just allow their life to pass them by. And they're happy staying kind of unconsciously incompetent in terms of understanding what levers they need to pull to create the life that they want. So the first thing that we do, and that's the reason why we created the wealth pyramid, is it's a really simple and easy to understand framework for you to identify where you are on your wealth journey and where you want to be. And the question you need to ask yourself is, are you confident in your ability to get from the stage of the wealth pyramid that you're at right now to the stage of the wealth pyramid that you want to get to in the time frame that you've set?
I love that. It's in the time frame that you set. So I want to be from here to here. So if you ask yourself that question and the answer is no,
or I'm not sure.
And yeah, well, I don't know that I don't know that, but I think so. If you're not sure, that's a red flag.
Correct. And
nice.
Once again, the biggest thing that I find gets in people's way when it comes to their finances is the uncertainty. No one makes good decisions out of fear. And if you're fearful and you're constantly asking, am I on the right track? Am I on the right path? Am I doing this right? Am I doing that right? Then it is going to impact how your decisions play out. Because when you're tentative in anything that you do, if you're a sports person, if you're a rally car driver, and I get rally is a great example, that in rally, you've got a 2IC, the map reader, and you've got to trust them inherently. They're calling out the turns and the angles, and you're essentially following what they say. And if you've ever go on YouTube and you search for rally driving mistakes, where the support person has said, left 30, and it's actually a right 10, then they drive off the other side of the road. But it's when they second guess themselves, they're like, actually, I'm not sure. They don't have that trust and that relationship. They don't trust the plan. They don't trust the strategy, or more importantly, they don't trust the person that they're working with. Then that's where things go astray.
Yes, when they get off the tried and proven, or the path that's going to take them. Some people just give up too soon and just say, oh, I can't do this, or start doing less because they're not progressing. And, they could be out of the woods in the very next day. So I think that's a nice way of putting it. Now, to wrap up our time together, given that we now know the difference between a coach and a financial planner, and I think there's this quite significance there, and we have some good ideas on what the mistakes are and how to fix them, and if a red flag. So I'm going to throw out to you, if somebody has just realized that there's a red flag there, that's, oh my goodness gracious, I want to do this, but I don't know if I don't know, I'm not sure that I can reach it in that period of time, red flag. Or I am making those 3 mistakes and I don't know what to do. What can they do?
A few things you can do.
What can they do? Can they reach out to you, go through a little bit of a strategy, or and maybe bare their soul?
Yeah, definitely. Well, first thing you can do is you can grab a copy of my book. If you're not ready to work one-on-one with someone, you wanted to start the process, grab a copy of my book, which takes you through everything that we've spoken about, all of the frameworks, all of the worksheets, all of the tools. There's even a worksheet in there that you can actually interview a financial advisor and a wealth coach and ask them all of the right questions that will help you make the right decision.
Great. Guys, I've got that book. It's great. It's one of the a financial book that I actually read, and it's really easy to read, and it's just absolutely chock-a-block full of gold. So it's absolutely outstanding.
Yep. And once you've done that, guys, then you can reach out for a chat. Book in a time with us. We can sit down. We'll take you through our discovery process. We'll actually start the process of mapping out your roadmap. Okay. To date, every single person we've taken through that has got a higher level of clarity than they ever have in the past. Because it's questions that they're not asking themselves every day, and things change. So we need to make sure that we start documenting those milestones so then we can work out what we're going to do to make it happen.
Terrific, mate. Well, look, you very generously gave me a link to be able to put it in the post with the video. Is it okay if I put that in again?
Please, chuck it in again. Guys, go through it, grab a copy of my book, book in a time to catch up if you haven't done so already, and we'll take you guys through the process, give you some clarity and help you kick some goals.
Great. Terrific, mate. Well, I'll pop it in today. Thanks, bud.
Awesome.
My friend. Outstanding. As usual. Gee, that was a 5 circles here with all my notes in it when I do my little mapping. So thanks. It was terrific.
Happy to provide you with the value, mate.
Guys, before we wrap up, Darren and Dee, do you have one extra question before we wrap up with Jackson?
One was, how do I get your book? So you've clarified that. Thank you. Link will be in the comments. You also mentioned the book Tiny Habits by BJ. Someone who was
BJ Fogg, F-O-G-G.
F-O-G-G.
And if you're having troubles with forming new habits, of trying to get in the pattern and the behaviors to achieve more and be a doer, a phenomenal book to read.
Love it. All right, I'll grab both of those. Thank you.
Awesome.
Dee, do you want to have another chin wag, or are you good to go?
No, I'm all good to go. I've written that book down as well, so that'll be something I'll be chasing up today.
Awesome. Well, again,
Enjoy.
thank you, Jackson, for you spending your time. Look, we'll put the link out there, get some books, and guys, reach out to Jackson, have a chat with him. As you can see, it makes it sound easy because he'll actually sit down and talk about your mistakes and have an operating system. So thanks, my friend. I appreciate it.
Happy to help. Look forward to catching up in a couple of weeks.
Terrific. All right, gang. What are you going to do? That was great. Gee, Jackson's good. Oh, gee whiz, I'm going to go away and do nothing, and I'll do it in Christmas time. Come on. Download that book, have a bit of a read, reach out to the great man and his team, have a chat. Every opportunity started with a hello. So why don't you say g'day and say, have a look, get the book, reach out and say hello. Put some comments down the bottom. Tell us what you're going to do. Doing is everything, not just listening. And we'll see you in a fortnight time with Manor Matters. And it's about money matters like a legal matter. Because Jackson said money doesn't matter. I'm Dr. J. We'll see you soon. Bye for now.